So when we're looking at the note process, there are 5 major steps from due diligence, pre and post closing, loss mitigation, and legal. And then there is REO / property preservation. That's when you get a property back and you're trying to protect it so that vandals don't do anything to it. And then there's the workouts, doing like REO, seller, carry, rehab. But when you have an REO, you do need somebody to property manage that for you. And this is something that Reed has a lot of experience in, but he also has experience in syndications with passive and active investing. So Reed is in our area, here in the Metro Detroit area. So Reed, why don't I hand it over to you, and maybe you can give us a little kind of a bio or something like that to tell us a little bit more about yourself, and we can go from there.
Sure. Yeah, my name is Reed Starkey. I am married and have 2.5 kids. We have a third one due in May, so we're excited about that. Our first child is actually the reason I got into investing. So I guess I started getting into it. I had my first flip kind of in progress, and our first son was on the way, and I was unable to get away from work as much as I had wanted to. So we decided that I would quit and invest full time, which was quite a bold move at the time, but looking back, it was the best decision we could have made. So that was 2015, and here I am still plugging away at it, and haven't looked back since. But most of my career, I guess I did a lot of flips. I did somewhere over 50 flips. And then I've accidentally kept some as rentals that turned out to be much more lucrative than flipping them. So started keeping them, and then in the process of buying rental properties, realized that no matter how good I am, buying one at a time is never going to get me to where I need to be. So that's when I got into apartments, and I've done one large syndication. I was a part of one we did down in North Carolina. It was 236 units. So I can talk a little bit about that. But I'm going to talk today a little bit about the syndication process. And as Phil mentioned, both sides of that syndication process. So there's the person who puts the deal together, and then there's the passive investors that maybe don't want to or don't have the desire to get involved in finding the properties and managing them, but would like to invest some capital that has a good return.
And just so everybody understands, when you're looking at notes, you can also syndicate it as well. So depending on how you structure things. So what Reed's about to share will have a lot of applicability depending on what strategies you're following in notes.
Yeah, and so I'm probably going to skip the slides since there's just a couple of us here. So I think I'll still use them for myself as a guide, but I think having my face might be a little bit more productive in a small, and also it'll encourage feedback. So if you guys want to jump in, feel free. I think that'd be a little bit better for this setup, if that works for you.
Sure.
So kind of what I wanted to go over today is, why apartments are a good investment, in my opinion. Some myths about why they are something you can't get involved in. So syndication, I believe, solves just about all those problems. What market should we invest in? How do you find a deal? And how do we know if it is a deal? So I'll kind of go over some of that stuff, and like I said, feel free to jump in and ask questions. I think it'll be good to have that interaction. So with apartments, the reason I think they're a great investment is they're scalable. So as I mentioned, when I was looking at single family homes, buying one at a time, So compared to the 236 units we bought, which did take between 6 and 9 months from start to finish to buy. So it was a lot of effort. It took a lot of people. But if I was to buy 236 homes, it would take me much longer than 9 months. And it would be almost impossible for me to accomplish. The debt on large apartments are non-recourse debt. So the debt we have on the 236 unit apartment, we're not liable for it. So if something happens and we are unable to make the payment, which hopefully does not happen, you know, the worst we can lose is the money we put into it. They can't come after us personally. There is a bad boy carve out on that. So if we were to embezzle or do something illegal, then obviously they can come after us. But with all good intentions, we are not liable for that debt. There's the tax advantages, which I won't get into too much, but many people in this industry pay zero taxes and take home quite a bit of money. And then obviously I must find some enjoyment out of it because I now own a property management company. I think the business is quite fascinating. You know, it definitely is fun to me, but it's takes a particular personality to be able to deal with all the tenants and different aspects of it. But I think it's kind of fun.
Just out of curiosity, can you back up when you said the debt that they can't come back on you? I mean, is that the way it was structured to begin with, or how was that? How were you able to come about that?
Yeah, so Fannie and Freddie, so they're government-backed programs for lending. They have what's called non-recourse debt, which means that if everything turns into a total disaster, you know, obviously we'll lose the money we put down into it, and we'll lose the building, but they can't come after us personally. In contrast, if I was to stop making my mortgage payments on my house, you know, they're going to take the house back and sell it, and if they don't get all their money back for the mortgage, I still am liable for that money. So if the house is worth 100,000 and they sell it on the market, or if the debt is 100,000 and they sell it for 50,000, I still am on the hook for the 50. Whether they can collect or not is a different story, but
no, thanks. I appreciate that.
Yeah, thanks for asking.
Oh, so
Typically-
can I further clarify? So it's a non-recourse loan you got from the government. Is that what you're saying?
Yes, well, no, it's backed by the government. So Freddie and Fannie don't actually make the loans; they just guarantee it. So a bank or a financial institution made the loan, but they were able to make it with really good terms based on the fact that it's that if we defaulted, the government would make sure the bank was whole.
Okay, so I mean, that's not a loan that's easy to get, is it?
It
Do you
is.
see that a lot?
It's much easier to get than probably one for your home. So there's some requirements that you have to meet that are much more difficult. But as far as getting it, it's rather simple. So once you have the net worth and liquidity requirements, they also have experience requirements. Once you have that, the loan is fairly easy. But as I'll get into a little bit later, it doesn't have to be you that has the experience, the net worth, or the liquidity. So we had 10 people on our general partnership team, and between all of us, we had the net worth, the liquidity, and the experience.
Okay,
And so that's why, you know, kind of, I'm jumping ahead, but kind of the resource myths is you may think, well, I don't have that particular deal. We raised $5 million. So the down payment we needed to buy it was $5 million. Well, I don't have $5 million and nobody else in the deal did. But we were able to come up with that through the group. So.
okay. That makes sense. Okay, thank you.
Oh, you're welcome.
Typically, the loan has to be at least $1 million in order
Yes.
to get Fannie or Freddie to guarantee it. Otherwise, you'll have to go to like closer to private lenders. or community bank or something like that.
Yeah, and there's other requirements. It used to be 800,000. There was a program, but I think that's gone away. It is definitely $1 million now. But there also is some occupancy requirements. So they will only lend on good performing properties. So if you're going to buy something that's non-performing, you're going to need to get a bridge loan or more conventional financing to make that happen. But then the terms become less beneficial to you. And sometimes they could be recourse debt, which is also unattractive for me personally. I mean, not that it matters. I mean, if we default on $16 million, I don't know what really matters. We're not, nobody has it. So, I mean, they wouldn't get it anyway, but it's good to know that they can't come after it. So as much as we'd love to think that we're amazing at what we do, you know, we don't have a crystal ball. The economy could fall off a cliff tomorrow, you know, and the property could be worth $20 tomorrow. We don't know, but hopefully not. It's not likely. We're in big trouble if that happens, but so that's kind of the thought. We just don't know. So all right, another thing that I like about the apartments is the scalability. And I kind of touched a little bit on that, was, you know, buying 236 at one time, but also a value add. So my house is only worth what comparable houses in the area sell for. There's not a lot that I can do about that. I can fix it up a little bit. I can, you know, put granite countertops in it and make it a little bit more valuable, but ultimately the value is fixed and not much in my control. Apartments are valued a different way. They're valued on the profit and loss of the business, and they're valued that way. So if I can, what's popular now is water savings. So you'll go in and you'll replace the toilets and the showers and save money on the water. And you know, usually you can extend the value of the property significantly. So an example, if you have 100 units in an apartment and you save $10 a year, let's say, on water, so you've got $1,000 a year in savings, which it would be more than that, but if you save just $1,000 in savings, your value of the property just went up $20,000. So that's $10. You know, if you can save $100 a unit, you know, now you're looking at $200,000 immediate gain in value. So you can see where that's scalable very quickly. We talked about the hold on. All right, so I'd like to talk a little bit about, you know, what is syndication. So as Phil talked a little bit about earlier, is you can syndicate notes, you can syndicate insurance, you can syndicate a movie, a radio station. Essentially, a syndication is if I have something that I believe will make money and I need to bring in other people to make the deal happen. So I can syndicate it and bring in other people. You know, like insurance companies will syndicate large insurance projects. So if you wanted to insure the Hoover Dam, you know, one insurance company may say, we can't afford that major loss if that collapses, but we can make a good money on it and we can share the risk amongst 3 other insurance companies. So they can syndicate it and say, hey, we've got this deal to insure the Hoover Dam and we want to split it between the 3 of us. And then that would be a syndication. You know, and you hear about it in radio stations, but if you're like me, you never put 2 and 2 together, but, you know, they say a radio syndication or, you know, a television syndication, that's what they're talking about. So when we say syndication, it doesn't mean necessarily just apartments. You could use it for notes. You know, if somebody had a note on a large expensive building, you know, and you didn't have the capital to buy it, you could certainly put it together in the same fashion. So that's what a syndication is. As it applies to apartments, you know,
Excuse me. Just so everyone knows, there are now people who will actually lend on notes. So if you bought a very large pool, you can get a syndication to help fund it, and you can then borrow money to help pay for that pool of notes through that syndication.
Interesting. We can borrow against borrowed money then. So,
Pretty much. I mean, once you've secured the note, then you're using the bankers to help get money out from what you've purchased. And assuming you purchased it at a good enough discount, theoretically, you could get all of your initial capital out.
that's a very interesting deal.
Yeah.
Interesting. We'll have to chat about that another time for sure. So in a deal, we talked about earlier when I said I was jumping ahead, we talked about the resources and the myths. And that's where it really comes together is, so on a typical deal, on this deal, we had a key principal, which that person was the person who was essentially signing on the loan. So again, it's non-recourse, so he doesn't have a lot of risk. His only risk is if we were to do something illegal, which, you know, he has vetted us a little bit and made sure that we're, you know, not those type of people. But he'll get a portion of the deal. We paid him a portion of the deal for it. And then he also had the majority of the net worth and liquidity requirements that they needed us to have. But you've got, you know, you can have people for the person who finds the deal does not have to be the person that syndicates it. So they could get a portion of it. You've got putting the deal together. You've got managing the asset. You've got somebody who's in charge of getting and securing financing as far as finding the lender that'll facilitate it and look at it. So there's a lot of components that you don't have to have the ability to do all of them, but you just need to be able to put together people that can. And one example of a deal that didn't go through, but just kind of an example of how these things can change. I looked at a deal in Rockport, Illinois, and yeah, Rockford. And so it was a loan assumption, which is a whole nother conversation. But with the loan assumption, they are a little bit more picky than a new financing. So they were giving us a hard time saying they didn't want to do the loan finance or didn't want to switch over to us, let us assume the loan. So when we dug into it, at first they told us that they wanted more liquidity. So we added a different partner to add more liquidity. So we had that. And then they said, well, we want somebody local. So the original owner that was selling it was local. And I lived here in Detroit area. So about 3 to 4 hours away from the apartment, which they didn't think was close enough. So we had one of the persons who was willing to invest in the deal, who happened to live about 10, 15 minutes away. So we were going to give him a part of the general partnership, which is the ownership side, in exchange for being the partner that was close to it. So that's how those things can be liquid. And then I'm going to jump around here real quick. So that there's two parts of a syndication. There's a general partnership and the limited partnership. So the general partnership would be who puts the deal together. And that would be all the people I was discussing before. So the person who is the key principal, you know, the person putting the deal together, and anybody else you need to make the deal happen. And then you have the limited partnership, which they do not have like voting rights. They don't have any control over the deal, but they would be somebody that brings money to the deal and will get a share of the returns from the deal. So if you hear me say general partnership or limited partnership, that's what I'm referring to. Did I lose anybody on that one? Okay. All right. So As far as the SEC goes, there's some things that you really need to be aware of. The Securities and Exchange Commission is the SEC. So what they're doing is they want to make sure you're not selling a security. And so we are selling a security, but they need to make sure we're doing it correctly. They've given us a couple provisions that, and I think there's some new ones that involve using a lot of people, but I'm not familiar with those yet. The two that I'm familiar with are a 506B and a 506C. Crowdfunding is the one that I'm not familiar with. So a 506B is basically a friends and family, and a 506C is accredited investors only. And with the friends and family, it allows you to bring in investors that are not accredited, but you have a relationship with them, and they can trust you because they know you outside. But it does not allow you to do any advertising at all. If you do want to do advertising, you do a 506C, and then you can sell to anybody, but they do have to be an accredited investor, which there's some criteria by the government that that ensures they're accredited, which I believe is $1 million net worth, or I want to say $200,000 a year. Don't quote me on that. I don't have the stats on that. Oh, 300,000 combined income if you're married, $200,000 each year if you're single. And then the net worth is excluding your private home. So if you are accredited, be careful. You can buy a home and uncreditate yourself. So in the 506B with the friends and family, they do say, and this is a very gray area, but you can only sell it to a sophisticated investor, even though they're friends and family. Essentially what that means is, they need to be competent enough to make the deal. And they're hoping that with the friends and family, you're not going to be taking advantage of somebody that doesn't understand what they're doing. So maybe an elderly person who doesn't understand and you're just taking their money, or somebody who's not mentally capable of making those decisions. So hopefully we're not making those decisions and wouldn't do that anyways, but that is what they say. And sophisticated is not really spelled out better than that. And it's kind of left a lot to our discretion. So as far as where should you invest if you're going to get apartments, I personally, there's different trains of thought. I personally have the train of thought that if you can invest in your area, I think that's the best place to invest. Some people will argue that, for example, I get a lot of slack for Detroit. So Detroit happens to be a declining market, has been for 70 years. And the population is going down. But I also don't invest in the city. I invest in the surrounding areas that kind of look bad because of the drain that Detroit puts on them. But the argument would be to invest somewhere like Texas or Florida or California, where people are moving to, and the population is rising, and then you're kind of just riding on that coattail. I have mixed feelings about that because you also pay a lot more for that. So you're paying a little bit for, if everybody knows the population is going up and they expect it to continue going up, then more people are investing there. And then you've also got more people building there, which is putting downward pressure on the pricing. So, I think if you're able to, it makes sense to invest in those areas. But I'm comfortable investing in Metro Detroit, and everybody I see investing in Metro Detroit is doing just fine as well. The one we syndicated did happen to be in North Carolina, which is also a pretty strong growth market as well. So, wherever you feel comfortable about. Some people actually also will look at investing in Orlando because they like to vacation there. So now you can go to Orlando and you can write it off, or write off a portion of it. And, you know, before you do that, talk to your tax attorney. But yeah, you can write off that trip to go look at the apartments. And, you know, if you happen to do some fun stuff while you're there, you can do that as well. So I'll talk a
So
little bit. Yes.
So you started out in North Carolina, right?
Yes.
And now you're investing here. What made you flip between the
Well-
two? Or are you continuing to invest like in North Carolina and this is just because you live here? So
Yeah, so
doing it two-pronged.
so the North Carolina deal was found by somebody else, and then I was brought on into the general partnership for for a little bit of advice and knowledge moving forward on my property management side, and then also to bring some money to the deal. So with bringing the 5 million total in, that's a lot of money, and it was friends and family. So the downfall of friends and family is once you've called everybody that you know, that's it. That's all the money you're getting. So,
Yeah.
if you do to accredited, you can advertise and you can do whatever you want to get more. Friends and family, you can't make friends in the process. That's illegal. You have to know them before you got the deal. So I helped with raising the money, and then I'm ongoing helping with manage the property. I'm involved in the weekly calls. But I did not source the deal. Somebody else found it. They brought it to me to help out. I underwrote it and it looked like a good deal. And, we've been working together since. So that's how the North Carolina deal happened. And I would easily go into some other markets like that. The downfall for me personally is I can't directly manage it. So I'm managing via proxy. So there's a property manager that we've hired that's handling the day-to-day stuff, and we're having just a weekly call. If I could do it here, I can drive by the property once a week, once a month. I can have those conversations directly. I'm controlling the property manager because we have a company that does that. And I, whether it helps or not, I feel a lot more comfortable with our control or ability. But that can be a downside too. When I'm talking to the property managers, and I try to be very careful in what I say, because just because they do it differently than I would do it doesn't necessarily mean it's wrong. So sometimes they make me cringe a little bit, and I just let it go because it's not that they're doing it wrong. It's just not the way I would want to do it. But I got to pick my battles and be careful. But overall, they're doing a great job.
So what's like the cap rate in North Carolina versus like here? Just kind of typically for like apartments.
So right now you're probably at a 5 or a 6 cap. So I have an interesting thought on cap rates. So it's difficult because I don't look at cap rates when I'm buying something. I'll look at a cap rate for when I'm selling it. But for those of you who does everybody know what a cap rate is?
Yeah.
Okay. So a cap rate is just a measurement of the net profit, and then to gauge what the selling price should be. The problem with the cap rate is, what numbers do you use? So with an apartment, you could use the numbers that it's performing at currently. But what if they're self-managed, so they have no cost for management? Well, even though I would consider myself self-managed, I still have property managers to pay. We have software, vehicles, maintenance techs. We have a lot of infrastructure to pay for, so it's not free. But you could have a landlord who's cutting his own grass and not charging. Well, we're going to hire somebody to do that. Their taxes are going to be much less when as when you sell a property, the taxes are going to go up. Our insurance costs lately have been much more than they were, just because the insurance companies have been taking a lot of loss and they're changing their rates. So when we sign up, it's generally more than they were paying. So our net operating income is going to be different than their net operating income. and usually less because, the expenses are going to go up. But also, if you talk to the broker, they want to rate the cap rate on future rents. So they'll say, well, the rents are $800 a month, but this is easily a $1,200 a month market. So we want to, if you were to get that much rent and no expenses went up because of it, then, your profit would be this, and here's the cap rate. So for that reason, I think cap rates are very subjective and they don't tell enough of the story. Maybe another component could be, the cap rate doesn't necessarily matter if we're getting the right interest rate on the loan. But if you get a 10% cap rate, which would be tremendous if you could buy it today, but you're paying 20% interest on your loan, then you're not going to make money. So what I prefer to look at is what are the actual returns that I expect to get from the property, and have that match where I'm at. So similar to notes, I assume that you have a particular return that you want to get. If you have a $100,000 note that you want to buy, hopefully you plan to get, I don't know what return is optimal for notes, but maybe you want to get a 10% return on your investment. So $10,000 each year on that purchase. So similarly, we'll underwrite it and we will put it in and try and do our best estimate of the next 10 years or 5 years, depending on how long we want to hold it. And we'll figure all the costs out and, try and really dig into what it's going to be. And then what is the returns that we have to get? And then we sell the returns to the investors. So we'll go and say, this particular deal has a 17% cash on cash return for average annual return over the next 6 years. And, that's where we're at. So did that kind of answer the question on, well, you didn't really ask the question on cap rates, but that was my.
Yeah, what we're seeing is like in Houston, the cap rates for things that are selling right now are roughly, say, about 5.
Yeah.
Versus secondary, tertiary markets are less than that, like 6%. But I'll bet up here it may be 7 or 8 instead of, because you've got more risk because there are fewer people moving, et cetera, here, whereas in places like Houston and that surrounding area, you've got so many people coming in that even if you make errors, you'll still make money. So you're paying a higher price for it. So, and I think that supports part of the reasoning that you had, which is why would you want to go to North Carolina and why would you want to come here? For you, investing here is probably less risky than investing somewhere else because you're right here and you can control the costs much better and you're getting better value for the money. Whereas somebody from Wisconsin investing here, this might not be as attractive as someplace like Houston.
Yeah, and I guess I'd like to say a good thing, but there's been so much competition lately. It's hard to say that, but I mean, there are not a lot of people from other states seeking out to invest in Detroit. Well, in the city of Detroit, there are a lot of people trying to invest because it's so cheap that it's attractive. I don't have any interest in dealing with the problems that come with the city of Detroit. But outside the tertiary markets of Detroit, you are still looking at about a 6 to 5 cap. Actually, recently, probably more of a 5 to a 4 cap. So, I mean, that cap rate's been really getting pushed down because everybody's trying to place their money. As you may know, that we have record inflations for the last 4 decades. And depending on where you stand on the spectrum of believing where the government numbers are of the CPI number, but people don't want to hold cash right now. They want their money in something that's going to go up in value with the, ride the inflation wave, and really take advantage of that. So people are trying very desperately to place their money. And unfortunately, we're all bidding against the same limited resources of properties out there. So that's why it's gone up quite a bit. But maybe to touch on cap rates again, another thing that really bothers me on the cap rate is if I was to build an apartment complex today and I have 0 people in it, I haven't rented it out yet. You know, that could be $100 million apartment complex, but if you use the cap rate, I would have to pay you to buy it. You know, or even taking maybe an easier example to think about is somebody who mismanages an apartment and it's only 50% occupied and it's just run down, but it's in good shape. You know, we could fix it up and rent it out if somebody managed it correctly. But at 50% occupancy, it's unlikely to be cash flowing positive. You know, that will not likely cover the expenses of the owner. So at that point, using a cap rate, it would be worth 0, you know, nothing. But that's just not true. So it has value, and that's why you have to really look at, okay, if I take it over, you know, I'm going to lose money for the first 6 months to a year. I'm going to have to probably cycle through the 50% of tenants that are in there because I doubt they were putting great tenants in there. You know, and I'll have to put new tenants in there, but once I get it fully occupied to where I think it can be and the rents to where I think it can be, you know, so year 2 through 5, I should make a good return. And now you can look at the return that makes sense. And realistically, you bought it as 0 cap, you know, I mean, infinite cap, but it still makes sense. So, so the North Carolina deal, when we agreed to purchase it, it was like 88% occupied, and then it was 96% occupied by the time we closed on it. So the value of it went up significantly since we agreed to buy it to when we closed. So that was really good, good for us. But you know, anyway, that's my long lecture on cap rates. I'm not a huge fan of cap rates, if you haven't noticed. But
I got a couple questions for you. One of them back on your non-recourse debt, on your loan for that, is there a normal duration on those? Are those like 10-year before they have to be restructured again? Or do they go out for any, is there a period of time?
yes, so there's 3, 5, 7, and 10. Those are your options, and they usually come with different interest rates. 5 is going to be usually your best interest rate. Some other factors that I'm not certain on affect those, but it just depends on the way it was explained to me is the 5-year, there's more people getting it, so that's where the interest rate happened to be the most favorable. And then, you know, with the terms, you can also get interest only. Right now, you can get 3 years interest only, and your interest rate's like 3 to 3 1/4. So essentially, they're giving you free money to buy apartments. What else is there? So there's a difference in prepayment penalties. So there's the defeasance. You can do a yield maintenance or a step down prepayment. Yield maintenance means that you're going to pay them the interest that they're going to make over the entirety of the loan. If you sell early, you just have to pay them the interest at closing. And then there's a step down loan, which would be, you know, maybe it's a 5% on year 1, 4% year 2, 3%, you know, and so forth.
So when that comes due after 5 years, can you restructure? Or are you looking at selling at that point?
Well, so with the nature of a syndication, you're typically going to sell. So as far as the financing is concerned, you have to buy them out. So that would either be a refinance or you know, a sale. With a syndication, typically it's going to be a sale. So on our deal in North Carolina, we have that one for an estimated 7 years. I would love to own it forever, and I'm sure everybody on the GP would want to own this forever. But the problem is it's I guess I haven't tried, but I assume almost impossible to raise money if you tell them you'll never give them their money back. So for that reason, usually you'll structure the loan for the 5 years and you'll say, hey, when this 5-year loan is due. We're going to find a buyer and we'll cash you out and you'll get your money back. And then you can invest in another deal later. So that's I think why there really is not a 30-year option for apartments, is because nobody's keeping them that long. For
Yeah, the other question I had, under your
Hold on.
syndication,
One second, Michael. I do have, I know someone who is in Texas and he's been doing syndications. And what they've done is after about 3 years, 4 years, they'll actually refinance and pay off everyone who was in the syndication. And then they'll end up carrying the new note forward with essentially the GP group. So,
yeah,
but that really comes down to how much has the operations improved and the value of the property as well.
so yeah, you can, just to clarify, you can structure the syndication any way that you want. I'm sure there's some limitations legally, but I've seen people do where they only pay them 8% and there's no upside beyond that. Personally, I don't really agree with that. I think if you're putting the money up, you should get some upside, but more power to them, because they're probably making a ton of money. The syndicators are, but you can do that. You can make the agreement to buy them out. So we don't have an option to buy them out in our contract for the North Carolina one. So if we refinanced and paid them back all of their money, they would have all their money out, but they would still own 70% of the deal. And that's fine. I don't have a desire to buy them out. I feel they were with us from the beginning and they should benefit from all the profits that we make on it. And if that became possible, which, it could, I mean, we're in talks with somebody, and I don't want to say much about it, but who's wanting to buy it for significantly more than we paid for it. And we've owned it less than a year. So if that happened, we would probably have to take it for sure. But, it's just all on how you have it. But this way, if we do that, we were going to double our investors' money in less than a year. So, I mean, that's pretty incredible. So if that happens, that's going to be great. I'd love to take all the credit for it, or at least the teams take credit for it. But really, that's just we're riding this wave of inflation that's happening. I mean, they're paying a lot more than we paid for it. So if it goes through, that's fantastic. But even if we refinanced it at that rate, we would still have to keep them in the deal.
Michael, I'm sorry I interrupted you. You had a second follow-on question?
No, that's fine. The other question I have is, when you're in a syndication, what do you do if one of your limited partners wants out?
So it's very clear in the contract that they sign. It's called a private placement memorandum. And it has a lot of legal stuff in it to make sure, again, like I said, with the SEC, it's probably a 50-page document that's extremely hard to read. I've read about 4 of them now, and they are challenging to get through. But in that document, it strictly says that you will not have an exit. There's no third-party market to sell these to. So, if you buy Coca-Cola stock and you want out, there's a market that's buying Coca-Cola stock, and you could exit in 30 seconds. And there is no market to sell this to. There's nobody to give it to. With that being said, if somebody said, hey, we need out in some way, shape, or form, we would put together an estimate of value and offer it to probably first the general partnership if one of us wanted to buy it, which, knowing that we've got offers where they're at, I would probably buy it immediately. So it would be very easy for somebody to cash out right now. But nobody's under any obligation to buy them out in any way. So when we sell it to them in the beginning, we tell them that there is no exit. which is not entirely true. There is a possibility of an exit, but I don't want them to buy thinking that there is an exit. I would prefer them just to not invest. And I tell them, listen, if there's any reason you think you're going to need this money in the next 6 years or 7 years, please don't invest. Like, just keep the money. So, and again, going back to the contract, you could write it in where you had to buy them out, but that might be tricky to figure out a value, especially if you were obligated to buy them out. And maybe expensive because you might have to hire an appraiser. But
Yeah, Reed, we're at 8:20, so maybe use 5 minutes for your last thoughts, then we can do final questions and wrap up.
okay, good. Well, I've got just a little bit more, so we can zip through it pretty quick. So I said places you can find deals. You know, LoopNet is one that I've seen people buy off of there. Usually that's where all the deals that couldn't sell go, so be careful on that one. You can network with brokers. There's brokers in the area. Berkadia is national, so wherever you're at, Berkadia is a pretty good one for big deals. But each submarket has its own brokers that are pretty good in their market. Networking, talking to property managers, and then one that I've been working on pretty heavily here is direct marketing through mail and cold calling. So I've been, CoStar has phone numbers that you can get, which are semi-accurate, but some of them are, and you can get a hold of the owners. And you know, most of them are not interested in selling, but it's a kind of a numbers game. So we've been calling them and trying to get a hold of them. And maybe a little backstory, my partner on property management, I actually met him through cold calling to buy his apartment. And we started talking, and we noticed we were looking at a lot of the same deals and became friends, and that's how we've become partners. So there's a lot of advantages to that besides apartment buying. And then the last thing, if you are going to look at a deal, it's, you know, I would recommend, again, not using like a cap rate to value it. There's lots of software out there. I happen to use Michael Blanc software. Doesn't mean it's better or worse than anybody else's, but I think his is pretty good. And when I bought it, it was $130. It could be more now. But I know there's many others. The Think Multifamily group has their own. You know, David Tupin, who's around here, I know he's got one that a lot of people around here like. But the point is, make sure you're using one so that you have a way to draw out your pro forma of what you think the property is going to make, and you can determine if those returns work for you. Things you'll need is the deal analyzer that we talked about. You'll need a trailing 12 months P&L, so you can look at what they were making and get an idea of what expenses are going to be for you. So the trash is probably going to be the same for you. You know, there's some things that'll be the same, and you'll need to learn the things that are going to be more. And then I like to look at the rent roll as well. So a rent roll is a good snapshot of how the property is performing today. So if in the North Carolina deal, for example, you know, we went from 88% occupancy to 90 or 98% occupancy at closing. So if you were to look at the trailing 12 months, they actually had much lower than that before that. So it would be difficult to use that income as an accurate gauge of what's coming, because there was a lot of vacancy before we bought it. So you could look at the rent roll to get an accurate gauge of how many people are there today. So that's why I like that. So that's what you need to get started on analyzing a deal. You know, if anybody was at that process of analyzing a deal, I'd be happy to spend some time with them individually, and give them some pointers, or at least kind of get them started, because there are a lot of variables, and it can be very difficult to get right. But if you do, I think it's a great investment to be involved in. So anyway, that's kind of everything I wanted to cover, and you guys had some great questions. So I appreciate the interactivity.
Awesome. Does anyone have any final questions for Reed?
No, I mean, I really appreciate you sharing that information with us. That was good.
Thank you.
By the way, that Michael Blank cash flow analyzer, I highly recommend as well. I think it's one of the best packages I've seen out there.
Yeah.
With that, thank you very much, Reed, for really leading the conversation and sharing with us your experiences in syndication and multifamily. I agree, it is definitely one of the great opportunities that are out there in real estate right now. And many of the things that you shared actually are applicable in notes as well. One of the things that happens though is that you'll make a bid, it'll end up getting accepted, you'll go into due diligence. And just like on notes, it's your opportunity to try to reduce how much you're going to pay because of various risks that you find during due diligence. With that, in January 10th will be our next meeting, and we'll have Andrew Pugh come and speak. He's going to talk about notes and his experiences with notes on mobile homes and other seller carried type notes that he's done in the past. So he'll be sharing his experiences and talking to us about things that we can do to succeed in those areas. Anyway, with that, I will wish everyone a great night. And if I don't talk to you, have a great holiday season. Thank you very much.
Yep, thanks
All right.
again.
Thank you, everybody.
Yep.
Bye.